Hey everyone, welcome back. Today, we're going to do a deep dive into the world of alternative investments
Okay.
in EMEA,
Sounds good.
Europe, the Middle East,
Okay.
and Africa.
Yeah.
We've got a ton of research reports to unpack,
Yeah.
covering everything from the people, like who are the actual professionals that are shaping this industry,
Right.
to the billions,
Mm-hmm.
literally billions flowing into all these different asset classes.
Absolutely.
It's pretty amazing.
Yeah, it's a fascinating landscape, and it's been changing so much over the past decade. We're talking private equity, venture
Oh,
capital,
yeah.
hedge funds, real assets like real estate and infrastructure,
Yep.
private debt, and then even, the exciting,
It's a crazy world.
always evolving world of digital assets.
Yeah, so much to explore.
Yeah.
But I think let's start with the people behind it all.
Makes sense.
Who are these players that are driving this whole alternative investment boom in EMEA?
Right.
And what kind of skills
Yeah.
are they bringing to the table?
Yeah. One of the most striking things we've seen is this surge of professionals that are moving from like traditional finance roles
Oh, yeah.
into alternative investments.
Makes sense.
It's not just about chasing higher returns, right?
Right.
They're seeking out new challenges, new opportunities
that's-
in this like rapidly changing industry.
Totally.
Yeah.
It's not your typical Wall Street image anymore.
No, no.
So what does this shift in talent
Yeah.
tell us about, how these alternative investments are changing? Are we talking about more than just like financial modeling these days?
Absolutely.
Oh.
Financial modeling is definitely still essential,
Yeah.
but the demand for expertise in areas like ESG, environmental, social, and governance factors,
Right.
that has just skyrocketed.
Yeah.
Investors are increasingly recognizing that ESG factors can significantly impact a company's long-term value and sustainability.
Of course, yeah.
And then, of course, like the rise of digital assets,
Right.
like cryptocurrencies and blockchain technology,
Jane, yeah.
has created a whole new set of like specialized skills
Yeah.
that are just so in demand.
Yeah, it's fascinating how these trends are impacting so many different fields.
Yeah.
You mentioned a surge in professionals
Right.
seeking that specialized knowledge.
Right.
Can you give us a sense of just how big this movement is?
Well, think about the CAIA Association,
Okay.
the Chartered Alternative Investment Analyst designation.
Mm.
It's basically become like the gold standard
Okay.
for professionals in this space.
Got it.
And their membership has just exploded. It went from about 8,000
Wow.
to over 12,000
That's huge.
between 2018 and 2022.
Wow, in just 4 years.
That's incredible.
That tells you something about how many people are serious about building a career in alternative investments.
Yeah, absolutely.
It seems like everybody wants a piece of the action.
Yeah.
And it's not just individuals.
Yeah.
Companies are growing too.
Mm-hmm.
What are some examples of that growth?
Take Ardian. They're a leading European private equity and infrastructure manager.
Okay.
Over the past decade, they've more than tripled their employee count as their assets under management have just ballooned to almost 100 billion.
That's wild.
This kind of growth is mirrored across so many firms in the
Yes.
industry,
Lots of sense.
just reflecting this huge influx of capital
Right.
and the increasing complexity of alternative investment strategies.
Wow, that's incredible. Clearly, the demand for expertise in this field is through the roof,
Yeah.
but it's not just about the number of people involved,
Right.
right?
Yep.
It's about the quality and diversity of their expertise.
Exactly. You got folks with backgrounds in investment banking, private equity, venture capital, real estate infrastructure, and even technology and data science.
Yeah.
It's like a melting pot of talent. And that diversity of perspectives is
Yeah.
crucial for navigating the complexities of the alternative investment landscape.
Totally. So we've got a rapidly growing talent pool, a shift toward all this specialized skill set,
Yeah.
and a surge in demand from both individuals and companies.
Oh, right.
It sounds like the alternative investment industry in EBA is firing at all cylinders.
It is, and that brings us to our next question.
Okay.
Where is all this talent and energy being directed?
Yeah.
What are the specific areas within alternative investments that are attracting the most attention and investment?
Let's move on to the big money then. How much are we talking about here, and where's
Yeah.
it all going?
Yeah.
All right, let's talk numbers. Just how big is this alternative investment market in EMEA?
Well, between 2015 and 2023, assets under management in EMEA alternatives nearly doubled.
Whoa.
Yeah,
Yeah.
reaching a staggering 3.3 trillion in Europe alone. That's up from 1.6 trillion
Wow.
just 8 years earlier.
Those are some serious numbers.
Yeah,
But it's not just about the overall size, is it?
right.
We're also seeing this shift in where that money's being invested.
Yeah.
It seems like private equity is becoming the dominant force,
hmm
even overtaking hedge funds. What's driving that change?
Yeah, you're right. There's definitely been a power shift there. European private equity fundraising hit record levels in the late 2010s.
Okay.
For example, in 2016, 109 billion was raised, jumping to an incredible euro 181 billion just 2 years later in 2018.
Wow.
By that point, European private equity was practically neck and neck with hedge funds in terms of assets under management, sitting at 559 billion. This surge in private equity was fueled by several
I'm all
factors.
ears. What were some of those specific factors that led to such a massive influx of capital into private equity?
Well, first, you have the great yield hunt.
Okay.
After the 2008 financial crisis, interest rates plummeted,
Right.
leaving investors hungry for better returns. This pushed them towards alternative assets, particularly private equity, which promised potentially higher returns,
Makes sense.
even if it meant taking on more risk.
So it's like investors were willing to step outside of their comfort zone
Yeah.
in search of those juicy returns.
Exactly. And it wasn't just about chasing yield either. Private equity, especially in Europe, had a track record of delivering strong returns,
Right.
which in turn attracted more capital. This created a bit of a self-fulfilling prophecy,
Yeah.
with success breeding more success. But there's another factor we haven't touched on yet, and that's the rise of specialized private equity firms.
Specialized firms. You mean like firms that focus on specific industries or sectors?
Exactly. We're seeing a rise of firms dedicated to tech growth equity, healthcare buyouts, specialized infrastructure funds, you name it.
Makes sense.
This specialization allows these firms to develop deeper expertise in specific areas,
Okay.
which can lead to better deal sourcing and execution.
So it's not just a generic private equity play anymore.
Right.
Investors are getting much more targeted
Uh-huh.
with their investments.
Right. And this focus on specialization is further fueling the growth of private equity. But while private equity has been grabbing headlines, let's not forget about infrastructure.
Yeah, good point.
It might not be as flashy as, tech startups
Right.
or leveraged buyouts, but it's quietly become the third largest alternative asset class by the late 2010s.
Why is that? What's driving the growth in infrastructure investment?
Investors are drawn to the stability and income that infrastructure assets offer, especially in uncertain times.
Yeah.
Think about it. Toll roads, airports, renewable energy projects. These are essential assets that people rely on regardless of economic cycles.
It's like investing in the backbone of the economy.
Yeah.
Makes sense.
Exactly. And the long-term nature of these infrastructure projects aligns really well with the long-term liabilities
Okay.
of institutional investors like pension funds and insurance companies.
Right.
They need stable, predictable returns
Yeah.
to meet their future obligations, and infrastructure fits that bill perfectly.
So it's not just about seeking high returns. It's about matching assets
Uh-huh.
with liabilities
Yep,
and managing risk.
absolutely. And let's not forget the impact of government initiatives
Oh, right.
and public-private partnerships.
Yeah.
Many European governments are actively encouraging private investment
Yeah.
infrastructure to upgrade their aging infrastructure and stimulate economic growth.
Interesting. So it's this combination of factors.
Mm-hmm.
Investor demand for stability and income, the long-term nature of the assets, and government support that's driving this growth.
Precisely. And as we look ahead, I think we can expect infrastructure to remain a key area
Yeah?
of focus for alternative investors,
Okay.
especially as governments around the world prioritize sustainable infrastructure development.
So we've got private equity booming, infrastructure steadily growing, this massive influx of capital into this alternative investment market in EMEA. But what about hedge funds?
Right.
They were once the kings of alternative investments.
Yeah.
Seems like they've been overshadowed lately.
Yeah.
Are they still relevant in this evolving landscape?
That's a great question. While hedge funds haven't experienced the same explosive growth as private equity or infrastructure, they still play a vital role
Okay.
in the alternative investments ecosystem,
Right.
especially when it comes to risk mitigation and diversification.
How so? How can hedge funds help investors mitigate risk, especially in today's, volatile markets?
Well, hedge funds employ a wide range of strategies that are designed to generate returns regardless of market direction. They use techniques like short selling, arbitrage, and derivatives to potentially profit
Okay.
in both bull and bear markets.
So while traditional investments might struggle in a downturn, hedge funds can potentially cushion the blow.
Exactly. And diversification is key. Having a portion of your portfolio in hedge funds can help reduce overall volatility
Makes sense.
and potentially improve risk-adjusted returns.
That makes sense. So while hedge funds might not be grabbing the headlines like private equity, they still offer valuable diversification benefits for sophisticated investors.
Right. But the hedge fund industry itself is going through its own evolution. We're seeing a trend of consolidation, with smaller funds struggling to compete and larger multi-strategy platforms gaining market share.
Why is that? What's driving this consolidation trend?
Investors are demanding more from their hedge fund managers.
Okay.
They want a proven track record, robust risk management, and transparent fee structures.
Right.
Smaller funds often struggle to meet these demands,
Yeah.
while larger platforms have the resources and infrastructure to deliver a more institutional quality experience.
So it's a survival of the fittest environment,
Yeah,
with the bigger, more sophisticated players coming out on top.
exactly. And this trend towards consolidation is likely to continue as the hedge fund industry matures and investors become more discerning.
Okay, so we've got private equity, infrastructure, and hedge funds all playing important roles
Mm-hmm.
in this alternative investment landscape. But we haven't even touched on real assets,
Right.
like real estate
Mm-hmm.
and private debt,
Yeah.
or the exciting world of digital assets. There's still so much to explore.
There is. And each of those areas presents its own unique set of opportunities and challenges.
Well, let's dive into those other asset classes then. We've covered the big picture.
Okay.
Now let's get into the details. All right, let's dive into these other alternative asset classes. First up, real assets. You know,
Right.
the tangible stuff, the things you can see and touch, real estate and infrastructure. They feel a bit more grounded than some of those complex financial instruments we were just talking about.
Yeah, that's a common sentiment. And it's part of what makes real assets so attractive. They offer a sense of stability and a hedge against inflation, which has been a major concern for a lot of investors lately.
Especially with interest rates rising.
Right.
People are looking for assets that can hold their value when everything's getting more expensive.
Exactly. And within real estate, there's been this popular theme,
Oh,
beds and sheds.
beds and sheds. Okay, that sounds more like a country song than an investment strategy.
Well, it's a catchy way to describe the focus on logistics and housing. The sheds refer to warehouses and distribution centers, driven by the relentless growth of e-commerce. Right.
And
The beds, of course, represent residential properties, which are always in demand, especially in growing urban areas.
now I get it. It's a play on the basic needs of a growing population, places to live and ways to move goods around.
Precisely. And this theme is playing out across EMEA. We're seeing huge investments in logistics infrastructure to support the e-commerce boom and this constant demand for affordable housing in major cities.
So it's not just about building fancy office towers anymore. It's about meeting the real needs of a changing society.
Right. And this shift in focus is creating opportunities for investors who understand these underlying demographic and economic trends. But it's not just about new construction either. We're also seeing growth in secondary markets and recapitalizations in real estate.
Meaning, what exactly does that mean?
Well, this means that investors have more options to buy and sell stakes in existing real estate assets and funds. It provides liquidity and flexibility, allowing investors to adjust their portfolios and take advantage of market opportunities.
So it's not just about holding onto a property for decades anymore. There's more dynamism.
Exactly. But we can't ignore the impact of recent events. The COVID-19 pandemic had a profound impact on real estate. It accelerated certain trends and created new challenges.
Right. Think about the shift to remote work and online shopping. Office buildings and retail properties took a hit, while logistics and data centers thrived.
It's fascinating how these macro trends play out in the real estate market.
It is. And investors have had to adapt their strategies, focusing on sectors that are resilient to these shifts and finding opportunities in distressed assets.
Yeah.
But speaking of adapting to change, let's move on to private debt, an area that's really come into its own over the past decade.
Private debt. Okay, I'll admit this one sounds a little mysterious. What exactly is it, and why should we care? Think of private debt, or private credit, as non-bank lending. It's funds making loans directly to companies, or for projects, often stepping in where traditional banks have pulled back, especially after the 2008 financial crisis.
So it's like an alternative source of financing for businesses that might have trouble getting traditional bank loans.
Precisely. And for investors, private debt offers attractive yields and a focus on income generation, We're talking high single-digit to low double-digit returns, which is appealing in a world where traditional fixed income yields have been so low.
Okay, I'm starting to see why this is interesting. So walk me through how this works. Who are the lenders in this market, and what kinds of loans are they making?
You've got direct lending funds, often specializing in middle market companies, real estate projects, or infrastructure development. They provide loans that are structured more like bank loans, with regular interest payments, and a fixed maturity date.
So it's not as risky as, say, venture capital, where you're betting on early-stage companies with unproven business models.
Exactly. Private debt is considered less risky than venture capital, or even private equity, but it still carries more risk than traditional corporate bonds, and that's reflected in the higher yields.
Makes sense.
Oh.
But what about rising interest rates? Wouldn't that make private debt less attractive since borrowing becomes more expensive?
It's a double-edged sword. On one hand, yes, rising rates make borrowing more expensive for companies. But on the other hand, they allow lenders to charge higher interest rates on new loans, potentially boosting returns for investors.
So there's more potential for reward, but also more potential for risk if borrowers struggle to meet those higher interest payments.
Exactly. It requires careful analysis and risk management. Lenders need to assess the creditworthiness of borrowers and structure loans appropriately to mitigate the risk of defaults.
Sounds like navigating the private debt market requires some specialized expertise.
It does. And one interesting trend we're seeing in private debt is the rise of unitranche loans.
I've heard that term thrown around. What exactly is a unitranche loan, and how's it different from a traditional loan?
A unitranche loan combines senior and subordinated debt into a single loan package. It's essentially a one-stop shop for borrowers, simplifying the process and giving them a single point of contact.
So instead of having to deal with multiple lenders with different terms and conditions, they just have one lender for the whole loan.
Exactly. And this can be appealing for borrowers, especially middle market companies that might not have the resources or expertise to navigate a complex financing structure.
Interesting. So it streamlines the process for both borrowers and lenders.
Right. And from an investor's perspective, unitranche loans offer diversification within a single loan, blending the higher returns of subordinated debt with the relative safety of senior debt.
That's clever. All right, we've covered real estate, infrastructure, and private debt. Now, for the grand finale, digital assets. This is the one I've been looking forward to. It's the Wild West of finance, with fortunes made and lost overnight. But is it all hype, or is there real substance behind the digital asset craze?
It's certainly a dynamic, and sometimes a volatile space. But beneath the hype, there's growing institutional interest in digital assets. It's no longer just tech enthusiasts and early adopters who are paying attention.
So the big players are starting to take notice. That's a sign that maybe there's something more to it than just speculation. What's driving this institutional interest?
Well, several factors are at play. First, the regulatory landscape is evolving, providing more clarity and stability. Frameworks like the EU's MiCA regulation, which governs crypto assets, are helping to legitimize the industry and attract institutional investors who value a well-defined regulatory environment.
Makes sense. Regulations can help reduce that uncertainty and make investors more comfortable.
Right. And beyond the regulatory progress, there's a growing recognition of the potential benefits of blockchain technology. It's not just about cryptocurrencies anymore. Blockchain has applications in various industries, from supply chain management to healthcare to financial services.
So it's the underlying technology that's really capturing the attention of institutions.
Exactly. And this is leading to increased investment in blockchain startups and companies developing innovative applications of blockchain technology.
Okay, I can see how that's appealing to investors who are looking for the next big thing. But let's talk about some of the key concepts within digital assets. What exactly are tokenization and DeFi, and why are they causing such a stir?
Tokenization is essentially creating a digital representation of a real-world asset on a blockchain. Think about representing ownership of a piece of real estate, a share in a private equity fund, or even a work of art with a digital token.
So instead of having a physical deed or certificate, you have a digital token that proves ownership. That's pretty cool.
It is, and this opens up a lot of possibilities. For example, it could make illiquid assets more liquid and accessible to a wider range of investors. It could also streamline transactions and reduce costs.
Fascinating. And what about DeFi?
DeFi, short for decentralized finance, it's about building a financial system on blockchain technology that operates independently of traditional financial institutions. It allows people to borrow, lend, trade, and invest directly with each other using smart contracts. and decentralized platforms.
Wow, that sounds revolutionary. It's like cutting out the middleman entirely.
That's the idea. And while it's still early days, DeFi is evolving rapidly, expanding into lending, insurance, asset management, and more.
Okay, my brain is officially full. We've covered a lot of ground today, from the rise of private equity to the complexities of DeFi. It's clear that the alternative investments landscape in EMEA is incredibly diverse and dynamic. But before we wrap things up, I'm curious, who's actually investing in all of this? Is it just institutions and the ultra-wealthy, or are everyday investors getting in on the action too?
That's a great question to end on. Let's talk about the investors who are shaping the future of alternative investments in EMEA.
Okay, let's break down this investor landscape. Who are the key players in this market?
We can broadly divide them into two groups: institutions and private wealth. Institutions are like the heavy hitters, the pension funds, insurance companies, endowments, and sovereign wealth funds that manage trillions of dollars in assets. They're driven by a need for diversification, seeking those enhanced returns, while also making sure their investments align with their long-term liabilities.
Oh, they're the ones with the deep pockets and the long-term perspective.
Exactly. And over the past decade, institutions have become much more sophisticated in their approach to alternative investments. They're not just passively investing in funds anymore. They're engaging in co-investments, direct investments, and even setting up separate accounts with managers to tailor their exposure to their specific needs.
So they're getting more hands-on, more strategic with their investments.
Right. And a big part of this shift is this increasing focus on ESG and sustainability. European institutions in particular are leading the charge, demanding that their alternative investments not only generate financial returns, but also make a positive impact on the world.
That's encouraging. It's not just about profit anymore. It's about aligning investments with values.
Absolutely. And now let's move on to the private wealth side, which includes family offices and high net worth individuals. These investors are often managing the fortunes of ultra-wealthy families and are known for their significant allocation to alternatives, often exceeding even institutional investors.
Really? Wow. Why is that? Why are family offices and high net worth individuals so heavily invested in alternatives?
Well, they tend to have longer investment horizons and a higher tolerance for risk than institutions. They're not as constrained by regulations or short-term performance pressures, allowing them to be more patient and opportunistic in their investment approach.
So they're the ones who are willing to take a chance on the next big thing, the ones who are driving innovation in this alternative investment space.
Absolutely. And they're not just throwing money at anything that sounds exciting. They're becoming increasingly professionalized in their approach, hiring experts, building dedicated teams, and using data-driven techniques to evaluate opportunities.
So it's not just about gut feeling and intuition anymore. They're bringing a level of rigor and sophistication to private wealth management.
Precisely. And here's another interesting trend we're seeing. The lines between institutions and family offices are blurring. They're collaborating more, with institutions co-investing with family offices and family offices adopting some of the best practices of institutional investors.
Plus becoming more of a collaborative ecosystem,
Yeah,
with different types of investors sharing knowledge and working together.
exactly. And that's a positive development as it brings more capital and expertise to the table, leading to better investment outcomes for everyone involved.
All right, so we've got the talent, the money, the investors, and the asset classes. It's clear that alternative investments in EMEA are a force to be reckoned with. But as we look ahead, what challenges and opportunities are on the horizon for this dynamic industry?
That's a great question. Let's wrap up our deep dive by exploring what lies ahead for this exciting market.
Okay, let's talk about the future. What are some of the key challenges and opportunities that investors and industry professionals should be thinking about?
Well, on the challenge side, macroeconomic and market risks are top of mind. Rising interest rates, the potential for recessions, and valuation corrections could all impact returns going forward. Liquidity and portfolio management also remain key considerations, as alternative investments tend to be less liquid than traditional assets.
So it's not all smooth sailing ahead. There are some potential storms on the horizon.
There are. And then there's the issue of competition and return compression. As more investors pile into alternative assets, competition for deals heats up, potentially driving prices higher and returns lower.
So it's a bit of a double-edged sword. The success of alternative investments is attracting more capital, but that influx of capital could also erode returns. It's like a game of musical chairs, and you don't want to be left standing when the music stops.
That's a great analogy. And finally, there are the regulatory and reporting demands. Frameworks like the AIFMD add complexity and cost for fund managers, and this ever-changing regulatory landscape requires constant adaptation.
Right, it's a complex and evolving regulatory environment. Yeah. But let's shift gears and talk about opportunities. Are there any bright spots on the horizon that investors should be excited about?
Absolutely. Despite the challenges, the opportunities in alternative investments remain immense. ESG and sustainable investing are becoming increasingly important, driving innovation and attracting capital to companies and projects that are making a positive impact. Technological advancements like AI and tokenization are revolutionizing the industry, making alternative investments more efficient, transparent, and accessible. And this growing trend of retail participation is opening up new avenues for growth, allowing individual investors to access asset classes that were previously the domain of institutions.
Wow. So there's a lot to be optimistic about. It sounds like the industry is evolving to meet the demands of a changing world.
It is. And as investors become more sophisticated and demand more from their investments, the alternative investments industry is stepping up to the plate.
Well, this has been an incredible journey. We've explored the talent, the money, the asset classes, the investors, and the future of alternative investments in EMEA. It's a complex and constantly evolving landscape, but one that's full of potential for those who understand the dynamics at play.
I agree. It's an exciting time to be involved in this industry, and I think we're just scratching the surface of what's possible.
And as you continue to explore the world of alternative investments, here's a final thought to ponder. With tokenization potentially unlocking trillions of dollars in illiquid assets, how will this change the future of finance and investing? It's a question that will shape the coming decade, and one that we'll be watching closely. Thanks for joining us on this deep dive.